Ladies and gentlemen, Your Excellencies, thank you for attending our panel today. My name is Volkan Kurtaş. I am the founder and chief investment officer of Vibrant Capital Partners. We are headquartered in New York, and our specialty is credit, structured credit, and securitized products. As we decided to expand globally into the East and South, we received the warmest welcome from Abu Dhabi, in particular ADGM. Therefore, please let me expand our deepest thanks to our chairman of ADGM, His Excellency Mr. Ahmed Razim Alzabi. Thank you very much for having us here, sir. We have distinguished panelists. I will let them introduce themselves. Maybe we start with a question. As you speak, you can introduce yourself. Thank you. For the sake of time. Arno, let's start with you, and Hazim, maybe we can continue with you. Great financial crisis versus the last 2 years, the next 2 years. Similarities, contrasts.
Thank you for your question. Arnaud Leclerc, Banque Lombardier, Swiss bank. We have seen over our creation 226 years ago, more than 40 crises, so it's just one of many. But what's different with this time, with 2008, actually? Few things, 7 points, quick ones. First one is that we have today persistent inflationary pressure. That's the elephant in the room. The second one that we see is that the US debt to GDP ratio has doubled, in the US as an example, relative to 15 years ago. And take the one in Italy as an example, 150%. We also have of course, the obvious acute geopolitical risk nowadays. The fourth one is that US savings rates have fallen sharply, and the high cost of living is going to make, households quite tough days in order to withstand this hardship. But in order to remain still reasonably positive, we can see that the labor markets is quite robust, much healthier than in 2008. As well, the banking sector, the balance sheet have been de-risked over time, and a number of large corporations have solid balance sheet today. And the housing market, typically in the US, is more resilient. Indeed, new home sales in September in the US have decreased minus 11%, but we're not in 2008. But probably there is a wider some reflections that we might have as in.
Very good. Well, the question was, how does the current crisis differ from the financial crisis? First of all, the financial crisis in 2008 was a crisis of liquidity and trust. I think you all remember that there were points where we were debating, shall we keep our money in this bank or put it in the other bank or open more bank accounts because we don't know which one is safe. And in fairness, to thank and congratulate the AGM and other regulators, the regulators have done an incredible job over the last 10 years, putting a financial system which is more responsible and more thoughtful than what it was pre-2008. So in reality is today, none of us have looked at the financial system with a question mark or with a lack of trust. Today, what triggered all this is an inflationary environment driven by a supply-demand imbalance. Is that temporary or permanent? Time will tell. And that inflation environment obviously led to an interest rate uphill, and then from there you have all the macro challenges. But if I can make two observations, which is very important. First of all, this is neither the first nor the last crisis we will live. It's okay. This is the nature of economies. They go through cycles. Okay? But here's what's very important. A financial crisis is like an exam. You prepare for an exam. You don't show up on the day of the exam and you say, oh my God, I didn't know there was an exam. Okay? We had a 14-year expansionary economic cycle. I think every single one in this room expected some kind of a downturn at some point in the future, at some point in the near term. And you prepare for it accordingly. And that's why I think what you see today in investors, those who have prepared for this situation and those who haven't. And that's where the bridge, I think the gap is going to be between the two.
Thank you. Crisis also means opportunities, right? So recently, during the pandemic and post-pandemic, we have seen a shift in economic opportunities, even economic power, from west to east and to south. Maybe, Karim, you can share with us your views on that.
Thank you. I'm delighted to be here. We are seeing a shift from the US, Europe to this part of the world because the growth is clearly here. If you look at the last quarter, Saudi grew at 12.2%, the UAE at 8%, the region will grow at 7% in 2022. I just came back from a roadshow in the US last night, and the last 2 years, investors were telling me, Karim, don't bother us. We're having a party in the US and Europe. We can't be bothered to come to the Gulf. I'm telling them, guess what? The party's over there. You have to come here because the growth is clearly in this part of the world. And not only in the Gulf, we are also looking towards South and Southeast Asia. We open offices across that region. If you look 30 years out, if you are a sovereign wealth fund, pension fund investor, Europe will grow by 1.5 times, the US 1.8 times. The Gulf will triple in GDP. Southeast Asia will quadruple, and India will quintuple. So if you want growth, you really have to be here.
Thank you. Hazim, your views on that?
As an investor, there are macro trends which you just cannot, you have to follow. So we have the world's two most populous nations, India and China, aggressively going to improve the livelihood of their people. We have the mineral-rich Southeast Asian countries that have now a very clear and concise plan of how to develop their nations. And also the sad reality, which is that China and the US is decoupling. It's happening. This is bringing two set of opportunities. First of all, the migration of the supply chain to other parts of Asia. But second of all, very interestingly, is the emergence of the China-centric tech space. And this is really kind of, there is a thriving rush into the venture capital and the whole tech ecosystem in China, which I say it with sadness because we all like to think of the world being interconnected. And finally, the sleeping beauty, Japan, a nation that has lived 3 decades of deflation, a nation that is sitting on 14 trillion of household savings, suddenly realizing there is inflation. There's something called inflation. And with inflation, that 14 trillion has got to go to work. So in that respect, where we see opportunities is private wealth in Japan, very interesting industrial opportunities in Southeast Asia, tech space in China, aging population, Thailand and China. These are the single biggest issue, aging population. Healthcare comes on the back of that. And really, I have to echo what Karim says. It is so exciting to see that the Middle East in general, UAE more specifically, and Saudi and others, are really, hopefully, this is the beginning of an incredible boom in the next decades. And ourselves, like many others, I hope will be a very active player in that momentum.
Thank you. Our panel is investment risk across asset classes. So I would like to get your views about sectors, investments, within the context of risk of inflation, increasing interest rate, slowing revenue, slowing growth. Maybe Arno, we get your views first. We continue with Karim, and Courtney will get to you.
Well, we are at a critical point in the cycle. That's for sure. And we have seen just very recently, maybe, inflation decelerating. That has created last Wednesday a big impact. And what we have to remember is that the capacities of all the fund managers to inject huge amounts of money in the system now are there. Okay, so that's going to be playing a big role. Now, to suggest at this panel, except private equity that we are a big fan of, I'm sure you do as well, that are definitely the case. We tend to favor sectors like pharma, companies, large equities with very solid balance sheet. We like the region as well, not just because we are here and we are nice, but we've seen recently some very nice IPOs and very positive ones. We like infrastructure, and sustainability is definitely one theme, which is, of course, after Sharm el-Sheikh, is in the heads of everyone, but is definitely something where we see, including in Europe, some fantastic companies, improving typically recycling or other infrastructure where it is worth investing nowadays. So these would be the main, You told me to be very quick, which is very difficult on these subjects because we could talk for hours, but I think these are the key elements that we look at.
Before we go to our panelists, let me actually pick up on that because the recent geopolitical situation since last February, what's going on in Eastern Europe, seems to have changed the perspective about net zero, carbon, coal, etc. Do you have a certain view that you want to?
We see that this is actually, probably it hasn't changed. This is probably accelerating what was going on already, very substantially. And what my colleagues have said today is very true. There is definitely a shift to Asia and to the region here. It's also a geopolitical shift to the region and to Asia. Not only Russia, as we saw recently, and not just because of the war in Ukraine, had already shifted to China and to export more oil actually in this direction. But we have seen also some diplomatic relations between countries from the region, which were not so much, so to say, which were more Western-minded or US-minded until very recently, and now just exclusively. So this has shifted definitely a lot. And to the net zero, of course, when we have these serious financial crises, priorities may be shifting, okay? So you speak less and you think less and you invest less potentially into a sustainable future and ecology. That may be the case, but it's there. And because don't forget, there is one key element also, which is the regulatory aspect of it. The rules in Europe typically are so stiff and strong in this domain that companies will have no choice but to adapt. And that is leaving lots of opportunities for investing.
Thank you. Karim, how about your views on sectoral allocation?
As a private equity firm, we focus very much on thematic investing. We're always trying to look into the future and seeing where is the growth in this part of the world. So very early on, we started investing in tech and fintech, healthcare, business services, and sustainability. We're big investors in water, food security, we look at renewables. And that really paid off for us. I was mentioning the economy is growing at 7% here. Our portfolio companies are growing at 21% annually. We're growing at 3 times the speed of the economy because we picked the right sectors. So I think focusing on where's the growth, which sectors are going to outperform is very important.
Thank you. Courtney, you're an expert in venture capital, so I want to ask you about the tech sector. We have seen very high valuations last year. There seems to be some reality coming back to the market. What are your views on that?
Sure. Well, as the lone venture capitalist here on the panel today, I think I may have a slightly different view on the next 18 months. Our firm, 500 Global, invests in 80 countries. Today we're managing about $3 billion that's primarily been deployed into early stage technology investments. And one of the things that we're most excited about, having done an analysis a couple of years back, we identified 15 countries that we felt the youth population, the expected GDP growth, the digital penetration, and the mobile adoption all meant that these economies would eventually, when combined, dwarf that of the US and China in terms of expected GDP growth. So for us, over the next 18 months, we're really looking to invest multi-stage in these 15 countries that we identified, the UAE, Saudi, Egypt, and many others being included in that assessment. And we believe that continued investment in early stage technology companies is key to the economic growth as we see regions like the Middle East diversifying their investments outside of oil and continuing to really drive knowledge economies. So for us, it's going to be all about continuing being very focused on early stage and growth stage investments across technology. FinTech, of course, is going to continue to be a huge driver. We also expect EdTech as well as general financial inclusion and infrastructure in these developing markets also continuing to play a huge role. So an exciting time to be in venture, but also a time where we expect there to be continued regulatory growth coming our way as well, which I believe is natural in any of these cycles, but certainly continuing to invest heavily in venture as an asset class.
Thank you. Hazim, how about your views on sector and investment allocation?
So obviously everything we say needs to be within the context of the environment today. We are in the middle of a financial crisis. It's a fact. You look through TV, kind of markets down 4%, up 4%. Crypto market is, well, I don't know, 40, 50, 60. I don't know what the number is right these days. During periods of crisis, the issue is you don't know when the crisis is over. And so you don't have your parameters to make your investment strategy. It could be, and nobody wants to catch a falling knife, but by the same token, nobody wants to miss a great opportunity. So during tough times, the approach we take is very clear. You gotta be defensive, and you gotta be opportunistic. How can I be defensive? What are the sectors that benefit from rising interest rates, inflation, what have you? Real assets, whether it's real estate or infrastructure investments. Second of all, credit. You may not make your 20% return on credit, but if you don't lose money, that is the single biggest step forward to being top quartile, not losing money. You don't have to be a genius. If you make money or don't lose money, and kind of in tough times, you're stable. That will comfortably put you top quartile, which is quite attractive. Second of all, opportunists. Areas such as distressed debt. Europe, I'm a big fan of Europe, where we have made the best returns on our private equity investments have been during difficult times, during challenging times. So in that respect, certain asset-light businesses in Europe, I think, could be quite attractive. The US is always compelling. I think every single one in this room can point to that they have made money in the US. But more importantly than making money, you can easily go in and go out. You can talk about that in many asset classes in other parts of the world. So in the US have this robust manner of always just bouncing back from macro challenges and what have you. So in terms of regions, it's got to be kind of a continuing focus on the stable or the certain market of the US, the opportunistic market of Europe, the exciting markets in the Middle East and Asia. And in terms of sectors, it's defensive sectors and also opportunist. And also the final thing is, it's okay to do nothing for 6 months. It's not the end of the world. Just having your pennies in your pocket is sometimes more valuable than stressing about it.
Thank you. A few words on credit markets, my area. In US, just if we take that, there's over $6 trillion investment grade bonds, but over 30% of it is BBB minus rated. So one notch downgrade and you are high yield. In the high yield market, the high yield bond market is about 1.5 trillion. 1/3 of that is B minus. So one notch downgrade, you are CCC. Downgrades and defaults will come, but last time that happened was 2009. And if 2009 you focused on credit markets, you do actually make the 20% return with relative safety. So I do ask the investors to keep an eye on credit markets for next 18 months. There could be very exciting opportunities. Would you like to add any further comments?
I think when it comes to being opportunistic, the next 2 years are going to show some really interesting opportunities. I think valuations are becoming more sane. There is a lot of growth definitely in this region. So you're buying right. We're entering as a private equity firms at a very attractive entry multiples, but we're buying growth. So this price to growth ratio is very interesting. And I think the 23 vintage is going to be very interesting in this region.
Thank you, everyone. My last message as an investor, please don't invest with the fear of missing out, I will say. Ladies and gentlemen, Your Excellencies, thanks for attending our panel. Thank you.
Thank you.